Or let's start. Okay. Hello, everyone. Pleasure to meet you. My name is Jan Czarnocki from Elastics. We are building AI agents for prediction markets, and we are starting with our private beta soon. So if you're curious what we are building, please apply for our waitlist. But we are not gathering here to talk about our product, but we are gathering here to learn more about prediction markets, because at Elastics, we firmly believe that prediction markets they are just a great opportunity to revitalize our sclerotic capitalism, I would say, but also propose perhaps an alternative political framework at some point and make information more widely available, in a sense that it's much more meaningful information for all the agents on the market. And we also believe that there's a lot of work to be done in terms of educating people about prediction markets and talking, like, dismantling a lot of myths that are about this asset class, or even the way of interacting with the financial market. So for this purpose, we invited today Professor Robin Hanson and Adhi Rajaprabhakaran. Professor Hanson is, of course, the luminary of prediction markets, writing about them for 30 years. And Adhi was working at Kalshi and is right now the author of the Substack blog 50 cents to dollars. Sorry, Adhi, is it the proper name which I'm talking about?
50 cent dollars.
50 cent dollars, which Adhi is on top of the developments in the prediction markets. Very hot topic recently, the insider trading. Both Robin and Adhi commented on this issue, so might be later we'll have a discussion. But just without further ado, I will like to structure today's meeting is that first I'll give a floor to Robin for his presentation about where are we going, perhaps into the future, in terms of like long-term shots about prediction markets and their political economy potential, let's say. And then I'll give the floor to Adhi, who will tell about the structure of this markets, basically. So the topic will be, will prediction markets be winner take all? And then I'll be happy to have a discussion between Adhi and Robin, and I'll be also happy to invite the questions from our audience. So if you have any questions, please comment under this post, under Elastics after this live stream, and we'll choose the most interesting questions and we'll ask them at the end. So without further ado, I'll give the floor to Professor Robin Hanson. Robin, the floor is yours. We're listening. Thank you.
Let me pick a screen to share here. Actually, window, and there we go. Ta-da. Do you guys see it? My screen share? Yes? Nobody's saying anything?
I don't see your screen. I see you, Robin, but I don't see your screen shared, unfortunately.
I picked it, and it says StreamYard is sharing a window at the bottom, and I picked the window for it to share, and
maybe you should
the bottom.
Now I see your slides right now. So we are ready to go.
Okay, great. All right. Hello, everyone. I'm Robin Hanson. I'm an economist at George Mason University, and let's begin. So, as you know, in the last few years, we've had this burst of activity on prediction markets, including with Kalshi and Polymarket. And that's why we're having this session here, why people are all interested in talking about it. Over centuries, we've seen a rise and fall of the legality of various kinds of gambling. And that leads us to expect that this might last for a while and then it might fall again. And so the interesting question is, how long will this last and what can we do in the meantime? But to point out, this is a very old dream. So in the early days of the scientific revolution, when the supposedly scientific physicians thought they were excluded from the schools in Britain, they issued this challenge. They said, let's take a bunch of poor people who are sick and split them up randomly, and let's see which of them have more people dead at the end. And they wanted to make a bet on who was better or right about this key medical ability topic. So that's the old dream that's been around for a long time, that we could have bets on important topics and use those to get better consensus on the important topics. Now, our world has a lot of different information institutions. An information institution is something that solicits contributions, aggregates them together into some sort of summary, and then spreads those out to an audience. And much of our world is shaped by these different information institutions we have. And my dream for a long time has been that financial market information institutions could become a much bigger part of our information world. They could play roles that are now played by the other institutions in other parts of our lives. And that seems feasible and even desirable because they have a number of good features, one of which is that they are just consistently more accurate than the others when in head-to-head comparisons. We've actually had a lot of particular studies where we looked at particular information institutions, comparing them to speculative market institutions, and quite consistently they're about the same, or the markets are much better. And that's the main reason to be interested. We do have some theory that tells us why this happens, but honestly, it's the empirics that are the main reason I would offer to you. So we do understand in the abstract that they give good incentives for individual participations. They give incentive for self-selection so that you should only talk about the subjects you think you actually know best on compared to other people. They give you incentives to go out and look for errors and biases in prices and fix those at the level of the bias you see, instead of sort of going through all the details of how they are created. That we get numerical estimates out of this that are consistent across many issues, frequently updated, turns out to be hard to manipulate. You don't have to decide who should participate. You just let everybody in and they self-select. They are at least as accurate as alternatives. And it turns out you can subsidize them in ways that just give money to the people who know best. Now, I had this insight roughly 38 years ago. So long ago, there was a world without a World Wide Web, and I was part of a team of people trying to create a World Wide Web. And we had this vision of why it would help the world, because we hoped it would make criticism easier to find. And then I started to have doubts about that. And then I asked myself, well, what else could we do to create better consensus and incentives in public policy and scientific discussions? And I thought, why not betting markets? And that's where most people come to this idea when they first think about it. Why not have a lot more betting markets on important topics? And then over the next few years, thinking more about it, I came to realize that if information institutions were going to be socially valuable, they would be most valuable when they inform decisions. So what we see in front of you here is our standard decision theory, our standard best story about how people do and should make decisions. And it says to compare your options, A, and for each one, calculate expected utility, i.e. a weighted average of the outcomes weighted by the chances of that outcome given the action you took. And information is valuable in this process by getting better estimates of the chances of outcomes given actions. And so I realized that information institutions in general and markets in particular would be the most valuable if we could create estimates right next to decisions. Those conditional probabilities would be the most valuable things we could have. And once you think about this, you realize we could just apply this all over society. Anytime we have a choice we're making, we could start estimating the consequence of that choice given the particular concrete options we'd have. We could do this for medical plans, inflation, school policy, security policy, choosing politicians, just all through our lives, we could have markets estimating the consequence of decisions. So as a concrete example, for several decades now, in the United States at least, we've had betting markets on presidential elections, and we've typically had estimates of what's the chance any one candidate will be nominated by their party, and then what's the chance they will win in the general election. And the ratio of those two chances is actually a conditional probability of the chance of a candidate winning if they're nominated. And that is advice to the political parties about who to nominate. If you want to win in the election, nominate the candidate who has the highest chance of winning if nominated. That's a decision market. And those have existed for decades. I don't know that, in fact, the parties have followed this advice much, but in the last presidential election, we had two prediction market adjacent sites called Manifold and Metaculus, which had conditional estimates like this for the consequence of the last US presidential election. You can see roughly a dozen here, particular predictions about if one party or the other party wins, what would actually happen as a result. So this is now giving advice to voters. Who do you want to vote for? Well, look at the consequence of who you vote for as estimated by these markets. So my history here is, it turns out that in 1981, somebody other than me not only had this basic idea, he ran a company on it for a couple of years and used this mechanism, decision market mechanism, to decide who to hire and what features to add to a finance simulation software that they sold. And this was a successful company. Since then, this person became rich and invested in other companies. And I came to the topic more like 89 in the general topic of prediction markets, and then 96, the more specific idea of decision markets, markets to estimate the consequence of decisions. And then I wrote about that and went on with my life, and not so much has happened with it until a few years ago, when a secretive government agency in India actually used this for making a half dozen decisions. And then a year later, a crypto firm called MetaDAO was founded as, its constitution saying it's going to make its key decisions this way. And since then, it's made roughly 100 decisions, and it had a dozen clients where it helps them make their decisions. And then a year later, roughly other firms have arisen to try to explore this mechanism in the crypto space. And so now, for a couple of years, we've been having concrete experiments and trials of this decision market mechanism in the corporate world. And I'm excited to see that. Now, all innovation is the combination of simple, elegant ideas with lots of messy details. And if I had a longer talk, or if you ask about it, there are a lot of messy details about how to make this work, a lot of complications that we could work through, and I have tried to work through to try to come up with acceptable solutions to various kinds of problems. In this brief talk, I'm just going to mention that we, have a number of particular tricks about how to set up prediction markets in general, using market makers, ways to limit sabotage. Turns out, and it even turns out that manipulation is much less of a problem with these markets. So manipulation is where, say, with a newspaper, someone might try to pressure the newspaper to have an article that slants a certain direction, because if people read that article, they might then take actions in a certain direction. And so people are all over the world constantly trying to influence information institutions in order to influence the perception they create. And we'll call that manipulation, when those pressures are not correlated with the actual information that is supposedly being presented, but just in order to get people to act in certain ways. And the same thing can happen with prediction markets. People can try to trade to move the price, even though they don't actually have information about which direction is more likely to happen, just because they want the perception that the consensus is in a direction, so that will influence people's actions. Turns out this is much less of a problem for prediction markets. And the key idea I can explain here is that our standard simplest model of financial market is there's two kinds of traders. One kind of trader knows something. They have some kind of information, and that information suggests the price should be different than it is, and they're trading to profit off of that information, and then in the process, they will make the market more reflect that information. When those are who I'll call wolves. The other kind of trader is who I'll call sheep. they are just there for any other reason. They, for example, are an employee who is saving for retirement. So every paycheck, they put part of the paycheck away to save, and that's a trade they have to make. And then when they're retired, they take things out of their retirement accounts in order to have living expenses. And then again, that's a trade they're making without necessarily knowing anything. So there's two kinds of traders, wolves and sheep. And the basic model of financial markets is that the wolves are trying to go where the sheep are. A wolf doesn't actually benefit if they trade against another wolf, because then they have opposite indications in their information, which cancel. In order to profit, a wolf wants to trade against sheep who don't know anything. And then on average, the wolves profit and the sheep lose on their trades. And so the basic fact about financial markets is the more sheep there are, the more wolves are attracted, and then the more accurate the prices get. So having more people who just make kind of random trades actually attracts more people who find and use information in their trades, which then makes the markets overall more accurate. And the main thing you need to understand about manipulators is they are sheep. They are just traders who have some other reason for trading other than the information they have. And so they fit this model of sheep. And so when wolves expect manipulators to be trading, they want to trade against them because they'll profit. And that is why they do so. And that's, in fact, a net gain for them. And that's why manipulation actually makes prices more accurate in prediction markets, which is a remarkable robustness compared to other institutions. Now, I'm going to tell you the following thing just to impress you. We've had an academic literature on prediction markets for a while, and one of the most impressive things we've done is created what I'll call combinatorial prediction markets. That is, you have a set of claims, and you can have a probability for each claim being true or false, or whatever set of values it has. And then you can ask for a joint probability distribution over the entire set of all those variables. And you can actually have a prediction market that does that. And you can have an edit-based interface where individuals go look anywhere in that joint distribution space and change it. Any number they think is wrong, they can move it and make it a different number. And that's how they make their trades. And we can subsidize this combinatorial market. And it turns out that doesn't cost any more than the subsidy for each of the claims that you had. If you have a subsidy for a market in each of the claims, and then you have a market in all combinations, it costs no more to do all combinations than it did for each trade. Typically, if you have enough variables, the combinatorial explosion means that even just representing as a data structure gets too big. So you need some sort of reduced form representation. And Bayesian networks are a common way to do this. And we actually had a system roughly a decade ago. We had over 1,000 questions. We had a Bayesnet structure representing all these questions. We let people edit any part of this joint probability distribution over these 1,000 questions. And they could even add and delete links in this Bayesian network. And we actually allowed them to, when they made an edit, we did an exact computation update of whether they were allowed to make this bet, given all their trades they've made before, and whether, how this changes everything in the whole network. And that was something that we did and are still able to do. And the field of prediction markets has been collecting technology like this that hasn't been used so much, showing that we just have a lot of potential here. Now, those are some more technical, messy details, but there's a lot more that we could discuss. Let me just mention some social messy details here for a bit. If you have like a company with a board like this depicted here, imagine you put at this table an autistic person who is very knowledgeable about the company and its details, but who has no sense of politics here. They don't know whose agenda anybody has here, what they're pushing, what they would be offended by, what they do or don't want to hear. This autistic person would be not welcome at this table. That is, they might be a trusted advisor for somebody here, but they would not be allowed to just sit here and blather things that are not in accordance with the agendas of other people at the table. But that's what a prediction market is. It has no sense of who wants to hear anything, and it just blathers whatever pops into its head. And that's why prediction markets are often hard to field inside organizations, because the people at the top of the organization want to control the narrative and are eager to, and in fact, reluctant to give a platform to anyone who would just speak out of turn without, respecting the agendas and positions of the people in power. So a concrete example is deadlines. If you're on a project with a deadline, you want to know what would help you make sure to make the deadline, but you also want a good excuse if you fail to make the deadline. And everyone's favorite excuse is the following. We were going along fine, and at the last minute, something came out of left field, and it meant we didn't make the deadline, but it's such a weird thing. It's never going to happen again, so let's just ignore it. If you have a prediction market going on all for 6 months saying you're not going to make the deadline, you lose this favorite excuse. You can't say we were going along fine to the last minute. And that's why people don't want prediction markets often in these situations. Also, often what people actually want is to get more work out of people, and they can often get more work out of people by getting them to think they're just on the margin of maybe making a deadline if only they all put in a lot more work. And they'd actually prefer people to put in more work than whether or not they make a deadline. If I had $1 million, I would do the following, and lately the cost of this seems to be coming down, so maybe we're near the point we can do it a lot cheaper. But just as a way to market this stuff, I would like to have for every company in the S&P 500 or Fortune 500, 2 markets. One says, what's the stock going to be if the CEO leaves this quarter? And what's the stock price going to be if the CEO stays through the end of the quarter? And those 2 conditional stock prices can be compared to say which outcome is better for the stock. And then the recommendation is to do that. If the company's worth more without the CEO, then replace them. If the company's worth with CEO, keep them. And I think you'd get a lot of press with this, and you'd even get CEOs trying to manipulate these prices. And this would, after a couple of years of data on this, you could even show on average that the companies that followed the advice did better, and then you could sue boards of directors to follow it. So that's an example of just how far we could go. We skip some other applications and get to a grand application. So apparently, for many years, I've been wondering how there's such a huge range of possible application here, so many decisions we could advise. How can I inspire people to really see the potential here? What I found is the most inspiring to people is to imagine national or even larger level governance based on decision markets. And I call that Futarchy. So my key argument is that if you look at, say, a nation, there are rich, happy ones. There are poor, miserable ones. It's not that hard to tell the difference. And so governments are rich or happy and not poor or miserable to a substantial degree based on good or bad policy choices. And what happens when they make a bad policy choice is typically that they don't know it's a bad one, or at least not enough people know it's a bad choice. If everybody knew and was clear that the choice was bad, it wouldn't happen. So governments fail to make nations rich and happy primarily by failing to make good choices, and they are therefore failing to aggregate information about which are the good choices. And speculative markets are, in fact, our best known institutions for aggregating information. So let's use them to find out which policies are good or bad. And that's the key idea here. So my slogan is vote on values, but bet on beliefs. So this is a diagram of our existing system where we have people at the bottom, representatives in the middle. People elect representatives. They vote in a legislature to pass bills. And on the side, we have various information institutions advising them about those choices. And we have courts that make sure that they follow legal constraints. The alternative proposing here now is we can continue to have people at the bottom, continue to have representatives. They're going to continue to pass bills. But now these bills will only decide what is national welfare. What is it that we want as a thing we can measure after the fact? Did we get it or not? So they can decide how much leisure counts, how much nature counts, how much international respect counts, wealth counts, etc. in national welfare. And then the policies are going to be decided by people making specific proposals for changes, and then speculative markets evaluating those proposals by getting an estimate of national welfare if you make a change versus if you don't. Comparing those two, information institutions of other sorts will still inform this process, but now speculative markets become the primary information institution for deciding which bills to pass. And that is vote on values, but bet on beliefs. And so the key rule of government here would be if a valid market estimates that national welfare is higher given a proposal, it becomes law. And so there's a number of complications that we could go into how to manage here. as with Futarchy more generally, there are complications, but I think that's my time here. So I will stop and we will go on and then we'll have questions. So let me stop screen sharing here.
Thank you. Thank you very much, Robin. We'll have time for the questions. Now let's give the floor to Adi. And
Thanks for having me. Let me go ahead and share my screen. Okay. Oh, spoiler alert. Computer's a little laggy right now. Wow, more spoilers, more spoilers. That's not what I wanted to happen. But okay. Jan, can you confirm to me that you can hear me all right and everything?
yes,
You
I
can
can
see
hear you.
everything?
See you. I can see the historical pattern slide as well. And now will prediction markets be winner take all, the slide.
Hello? Okay, I'm
Yes, Adi,
just
I hear
gonna
you.
assume that it's working. Well,
All is working,
anyways,
Adi.
thanks,
All is
Jan, for
working.
having me. I'm excited to be here and excited to follow a luminary such as Robin Hanson. I'm also an economist, so I don't know if the people who signed up for this knew that they were going to be talking to two economists, but I am a bit more commercial. I think I'm going to be talking about this industry, but from the lens of, I think, an industrial organization economist who might think about why some industries are monopolistic, why some industries are perfect competition, and where prediction markets are going to land on this scale. And I would love to just talk about a little bit about the history of derivatives and what I think the future of this prediction market industry will look like from that lens. Um, so typically, the derivatives industry is very monopolistic, right? We have, since the CFTC was incorporated in the 1970s, we've kind of come down to three main players in the Chicago Mercantile Exchange, the Intercontinental Exchange, and the Chicago Board of something, the CBOE. I forgot. And so these three exchanges are all CFTC regulated, designated contract markets, and they have enjoyed the spoils of really dominating the derivatives industry in a duopolistic or triopolistic manner for the past few decades. And what we've seen is that the market has become more and more concentrated over the years, and I want to dig into why. So the first thing I think is that these derivative contracts are unique as an asset class in that they're not fungible across exchanges. So, with crypto, you can buy a Bitcoin on one exchange and then sell it on another, especially with decentralized exchanges. Um, but if you buy an oil future on CME, you can't then go and sell it on ICE, right? The future is a contract that is locked into the exchange that you buy it in. And not only just locked into the exchange, you're locked into the specific product. So it's where will oil be in October 2030, right? And like that is only going to be bought and sold in that specific liquidity pool and that specific exchange. And so I think that causes a lot of lock-in that makes it more monopolistic and more winner takes all. The other thing is that derivatives have typically catered to traders who want to trade a lot in size. These are people who want to buy $20 million on an oil future or $100 million on Eurodollar or even a billion. I think you can actually on foreign exchange futures markets, you can get down a billion without much slippage. That's how deep and liquid these markets are. And these markets are important for the functioning of the world economy, right? And so when you are trading this much size, you really care about going to the venue that has the deepest liquidity. Because if it doesn't have the deepest liquidity, then you're going to get a worse price for your trade. And so this combined with the non-fungibility aspect that's unique to derivative contracts makes it so that once an exchange kind of wins, like becomes the place to trade um, oil futures, for example, traders, liquidity demanders, and liquidity providers and the liquidity observers, the market observers, they don't want to go anywhere else, right? There's one best place to do it, and that begets itself, and it becomes this positive flywheel. It becomes something that is pretty much impossible to usurp. And in history, there was only one time that I was able to find an example of a futures exchange that had a dominant position and then lost it. And it was a obscure German bond futures exchange that was just really, really slow to adopt electronic trading and the internet. And so they got disrupted by a completely different exchange, and the disruption happened very, very quickly within a year. So, but typically, it's almost impossible to disrupt a moat like that. And then the last thing that makes it like very difficult is that typically there's a huge startup cost with building a derivatives exchange, especially an American regulated derivatives exchange. Um, to get a DCM, a designated contract market, typically took years, 3, 4, 5 years was not uncommon. It takes millions of dollars of lawyers' fees, of consultants. It takes a lot of capital upfront to prove to the CFTC that you have this like a year's worth of operating capital so that you're reliable. And also it's just like really hard. I worked at Kalshi for years, the first regulated prediction market, and there was dozens of times where it was just very, very difficult to like figure out really niche, weird regulatory kind of quirks about how to move money around or how to do daily accounting, stuff like that. It's just like it's not like crypto where you can kind of just copy the code of another decentralized exchange and get going. It's quite a significant barrier to entry. So these three factors have defined, I think, the derivatives industry for the past 5 decades and have made it very monopolistic. So um, the second order effects of these factors is that the way exchanges have competed over the past 5 decades is not by listing the same contract as another exchange. It's by trying to innovate and invent a new product and then be the first to get that liquidity, order flow, fungibility lock-in that we discussed earlier. So a great example of this is CBOE. They, instead of trying to like become the place to trade interest rates, they created a novel product in the VIX, which is a volatility index, and then started issuing futures on volatility. And credit to them, they identified that volatility itself is something that a lot of market participants need to trade on, want to speculate on, and need to hedge against. And so they created this product. They became the best place to trade volatility, and that and one or two other products are the bulk of their business. And that's like that's a $20 billion company, right? That's kind of goes to show like you don't need to win in the traditional world of derivatives. Don't need to win everything. If you just win a couple important products, those become very profitable and high margin and phenomenal businesses to run. Another thing is that we've seen a lot of mergers and acquisition activity, M&A activity in the exchange layer for the past few decades. A lot of this is driven by factors such as demutualization. So before, exchanges used to be owned by the floor traders. That changed because now there was a lot of factors kind of coming into this where the internet was making it was making floor traders less relevant, to be honest, obsolete. The internet was also making it so that you didn't need to have a separate grain exchange in every part of the country. Like one price discovery could happen in one venue because the price information could be transmitted very easily across the country. And so, due to these factors, this drove this wave of demutualization where the traders would sell their equity in the exchange back to the exchange, and then the exchange would go public, and then use that money to then go buy other exchanges. And a big reason why this would happen is because when you have related products that are trading, it's important to have them under the same venue because that enables cross margining, right? So if you have $1 billion position on interest rates, the exchange then calculate, okay, like this $1 billion position on interest rates will, if you want to buy a gold future, because gold futures and interest rate futures are related in some way, they calculate the correlation. Then we'll lend against your $1 billion interest rate position so you can go buy $500 million of gold futures if you want. And this feature of being able to cross margin and turn $1 into many dollars is like very paramount to the growth of liquidity and order flow across this ecosystem. And that just makes the risk transfer and the economics and the speculation much more buttery smooth. So these exchanges were very incentivized to acquire each other because it was like a win-win-win. The acquiring exchange would pay significant economics to the acquiree would get paid, and the traders were happy about it because they get a better trading experience. And so this win-win-win situation led to a lot of like M&A activity in the past 2 decades in particular, since the internet became a thing. And so we see here like the CME group is called group for a reason. They've been the killer in this space, buying up anything and really dominating everyone. And ICE has followed a similar strategy too. Um, so now that's how the previous few decades of derivatives, CFTC regulated derivatives industry works. I want to talk about now like what I think the next decade or maybe the next 5 decades will look like. Prediction markets are different. In prediction markets, liquidity does not matter that much. If we look at the average trade size of prediction markets today, it's quite low. It's around $12, $13. Obviously, it's an imperfect way to calculate it because people will make multiple trades to build a position, but it's just the point is that like when people are trading tens of dollars or hundreds or just a thousand or so, um, they don't care about having the deepest liquidity. And so then the second order effect of that is that someone can be the second or third or fourth or fifth person or fifth exchange to list a Super Bowl market. The people betting on the Super Bowl like don't really care, right? Like it's the same market, it's going to have the same prices. The arbitrageurs are going to be doing the same thing across all the exchanges, and so you don't really care about your execution. And I think there's just this like inverse correlation between price sensitivity and the size of the trade in general. So that's another thing I'll touch on later in this talk. But yeah, because of that, this like liquidity flywheel doesn't really spin the same way. And then this is another thing. This is actually related to a recent blog post I had called Minimum Viable Liquidity on my blog called 50 Cent Dollars, where I talk about how if you conceive of the point of prediction markets to produce information, then there's actually an argument to be made that like more liquidity is not actually necessarily more, right? Here I have a plot where I calculated the accuracy of every inflation forecasting market on Kalshi for the past few years. I was a market maker for Kalshi, and I was primarily responsible for the economics desk at Kalshi Trading. So I was very familiar with this and did a lot of the pricing myself. But I show that, oh, this is way too big. But basically, you can see that there's very little relationship between the volume that was traded in an individual CPI event and the actual accuracy of the market in the end. And this is, I think, an anti-pattern of prediction markets that is really underrated. You just need enough liquidity in the market to get the person who knows the true price to care about it enough to then move the market to the true price. And in the case of CPI markets on Kalshi, there's like a couple CPI inflation nerds, including myself, who did all this work to forecast CPI on a month-to-month basis. And we're doing it for just at some points, a couple $1,000. Like it was such an important story and important value that we were producing as traders. We don't need billions of dollars to do it, right? I think that's something that's also underrated about prediction markets. So move on to the other thing that's changing about prediction markets is that we're now in a world where I think the startup costs around getting a DCM license is falling rapidly. We just saw someone get a DCM in 6 months, which is or almost 7 months, which is like very close to the statutory minimum. Right now in the laws, in the regulations, it says it must take at least 180 days. And this is like a record. No exchange has ever gotten a DCM this quickly. People are used to the CFTC is used to giving out prediction market DCMs. They're much more forward about it. Michael Selig, he went on Odd Lots the other day and talked about how he was, it sounded like he was proud about how quickly they were able to approve this latest DCM. And I think that trend is only going to continue. And I think DCMs are going to start to get approved even faster than the statutory minimum. There's probably going to be some kind of guidance or rule making that is going to lower the barrier to entry even further. So my forecast is that I think in the next 3 years and under this administration, there are going to be dozens more prediction markets trying to compete with Kalshi Poly Market and et cetera. And so, yeah, I should have tapped to this earlier, but here's just some data about prediction market or DCMs getting approved by the CFTC and how long it's taken. And predict it. They got their DCM DCO. It took them almost 4 years. QCX, which got acquired by Polymarket, took them over 3 years. Railbird took them 2.5 years. That got acquired by DraftKings. And so now I think this part of the market structure is going to open up significantly. And so we'll see a lot more competitors in this space. That said, though, it's not easy. It still takes millions of dollars. It's not something you can just kind of hack together over a weekend like a crypto exchange, but it is getting easier than ever, and it will continue to get easier. We'll see where the limit is on that, though. And so then another thing is that I think prediction markets can show up in multiple forms. They can be the exchange. They can also be the broker. As we see in this plot, like the number of operators owning an FCM license, which is the license to operate a brokerage like Robinhood or Coinbase, dropped precipitously since the 90s. And I think that given this new era of prediction markets, that is going to increase a lot, because that is kind of the app layer to this industry, while exchanges are somewhat approximate the infrastructure layer. The lines get blurred a bit, but this is just something where I think there's a lot of money to be made, and a lot of people are going to be trying to get these licenses. And this is just a number. These numbers in red are numbers that I pulled out of my ass. I think that this might happen, but the numbers in black are real. And so we'll see how this industry evolves in the next decade. But I do think this is a possibility, a strong possibility. And so another point on the regulatory greenfield, like I had an article called Regulatory Greenfield I published on my blog a couple of weeks ago, just covering how this new CFTC is very, very pro prediction markets, and seemingly is about to just let it rip, I think. And so when you have this kind of regulatory clarity, that de-risks the industry significantly, that's going to lead to more allocation of capital and human capital in particular, I think, towards this industry. And when those kinds of things happen, you tend to see a lot of growth, and you see a lot of competitors, and you see, I think, a pretty healthy market structure of platforms competing. And so I think that's where we're headed. And then on the last thing about the non-fungibility, it's still there, but it's not that big of a deal. I think you see evidence of people, they have multiple sports betting apps on their phones. They'll bet wherever they have the best price, and they don't really care to buy and sell the sports bets that much. I think things will change as we get into different types of market structures, but the reality is this non-fungibility thing is still true, and I don't think it will ever change. There's just the way derivatives contracts are regulated. There's no incentive for anyone to make it so that you can buy Patriots to win the Super Bowl on Kalshi and then sell it on Polymarket. I think that will just never happen. So again, this unique combination of these three traits, where that's not true of stocks, that's not true of crypto. I think this is like a very interesting kind of wrinkle in the puzzle here. So if liquidity doesn't matter and startup costs are getting cheaper, like how will people competing in this industry actually compete? I think it's a good question. It's something I've thought a lot about in the past few months. And here is my theory about what's going to happen. So first, I think distribution is going to matter a lot more than liquidity. I think it might be maybe the only thing that matters, in that when you don't have to worry about having the deepest liquidity. All you have to really worry about then is having the most users, and just offering them the same thing that they could really get anywhere else. I think then the next order effect of that is that, okay, now we're talking about offering things. I think these exchanges are going to engage in this memetic competition to list as many contracts as possible, right? Especially if you think about prediction markets more closely approximating a media product than a trading product. You will want to, when 18 months from now, when you can have 9 different prediction market apps on your phone, which one are you going to open up on a daily basis or deposit in? And I think it's going to be the one that allows you the broadest menu. If you want to look at prices or trade on sports, you can do that. If you want to look on at like what Zohran Mamdani is going to do, you can do that. If you want to look at what Taylor Swift's album is going to do, like you can do that too. And so that is going to be how I think a lot of these exchanges compete, is that like there's just listing as many markets as possible. And then also discovery editorial judgment. We've seen now, if we live in this world where there's like, say, millions of prediction markets across dozens of exchanges, um, the prediction market that is able to most efficiently surface the right contract, the right market to the right person and get them engaged in a way that, TikTok does with their algorithm, is one comp you can make. I think really important way to compete. And then also using some judgment about which markets you list and which markets, importantly, which markets you don't list. I think we've seen plenty of examples, without naming names, in the past weeks and months of exchanges listing contracts that are not exactly in the best taste and just piss people off. And so while there's this tension between this memetic competition to list the most markets possible and list a bunch of markets that the other exchanges don't have, I think we're seeing the limits of that competition where, okay, well, we listed this market and it was a complete PR disaster, and maybe we shouldn't be so maximalist about the menu that we're offering. And so I think that's something we're all in a learning process, and it's something that we're going to be figuring out over the next 3 years. And then importantly, I want to emphasize this too. I don't think having lower fees is a way to compete. There's just so much empirical evidence that most people just don't care about fees, right? Like most of the volume on Kalshi for a long time was being delivered through Robinhood. And if you look at Robinhood's fee structure, it is universally at every single price, at every single um, way you make a trade, the fees you're paying on Robinhood was always more than the fees you're paying on Kalshi. And that is just a really great piece of evidence that like people don't care about the fees and are not very price sensitive. And these negative expected value traders are kind of like the lifeblood of any industry, actually. So if an exchange is trying to compete with Kalshi and Robinhood, and their concept is like, we're going to be the fee-free exchange, we're going to be the most efficient or whatever, I just that will work if the markets you're listing is institutionally grade focused. If it's retail oriented, if it's, what is Taylor Swift going to do or who's going to win the Super Bowl, I just don't think it matters. And so that's an important thing to call out, I think. So let's dive into the example of Robinhood. I think it's like very illustrative. This is the first time Robinhood has ever in its history acquired an exchange to compete with an exchange that it was servicing at that moment. So in this example, Robinhood was connected to Kalshi, and then they bought their own DCM and are going to build one and probably edge out Kalshi in the long run, off of their platform. And I think that is just a proof point that like shows that when you control and you own the user at the end, that means you have the power and the leverage in this industry. The exchange used to be the hard part, and then the broker was the commodity part. And I think prediction markets, because the average trade size is lower, completely inverts this dynamic, right? Like now the broker and owning the user is the hard part and the important part, and the exchange is kind of getting commoditized. And I'm going to demonstrate that and apply in the next slide. So this is a net new. I have not shared it anywhere, and it's going to be in a blog post that's coming out in a couple days called the Robinhood Effect. But you guys on the stream are the first to see this analysis that I've done. But basically, what you're seeing here is that on one day in the month of February, Robinhood decided to point all its order flow on NBA games to an exchange that wasn't Kalshi. And if you look at the pattern of the trade data, I went and downloaded all the trade data from all the exchanges. I matched them across the game. I matched them across time and the date. And you can see here that every bar here is an NBA game. And most NBA games do a couple million. Some marquee matchups do a lot of volume. Um, and you can see here that like most of this flow, Kalshi was, getting it. They were doing fine. They're making a bunch of money, sure. And then on one day, on February 12th, Robinhood decided to make the exchange that is being traded on their platform to be ForecastX instead of Kalshi. ForecastX is the DCM operated by Interactive Brokers, a competitor to Kalshi. And you can see here that Kalshi's NBA volume then fell by 80% on that day. And then Forecast X went from having essentially zero NBA volume to having millions. And this dynamic here is I think this is a very powerful, economists, we call this a natural experiment, right? Where I can't like prove to you, I can't tell you how much of Kalshi's order flow is coming from Robinhood. I don't know. I don't work there anymore. I don't work at either place, but like this is a really clear example of like the power that Robinhood has. They can kind of just king make any exchange that they want, and point their order flow wherever they want to point it. And so who knows what was happening behind the scenes in this couple week period between Kalshi, Robinhood, ForecastX. I don't know what they were discussing with each other, but it's clear that this was a little bit of a flex on Robinhood's part, and really shows their power here. Again, more analysis on this coming later in a blog post coming later this week. So I think that's just throw a bunch of data, a bunch of information at you to talk about like the market structure implications are that there's going to be, I think, more competitors than traditional derivatives because of these dynamics. There's going to be less mergers and acquisitions of rolling up of exchanges because exchanges are going to realize it's actually better to own the whole stack and de-risk themselves from other platforms. I think another way to compete is like customer acquisition because owning the customer in the end is the most important thing, as we saw with Robinhood. And if the TAM of prediction markets continues to grow, which I believe it will, I think it's going to be a lot more than sports. I really deeply believe the potential of prediction markets so much bigger than just sports betting. Then there's going to be opportunity for companies that aren't, Kalshi, Robinhood, Coinbase, Polymarket, DraftKings, whatever, right? There's going to be a lot of room for innovation, and if we go back to that CBOE example where CBOE was the first to think of the VIX and invent volatility features, and they became a phenomenal business just off of that. I think the nature of prediction markets is the remit is that like you can have markets about anything, and people who can be creative in what kind of markets they list and what kind of products they're offering can build great businesses here. So I do want to another like I'll try to go through this quickly. I know we're running out of time. But like one thing, if we think about the end game, the game theoretical outcome of a bunch of exchanges competing by listing a ton of markets, there's going to be so many prediction markets, and I think that is going to cause a lot of issues in that different exchanges will write different rules, they will resolve differently, market makers won't know how to hedge them, um, and so I think that when you consider the outcome of these exchanges competing, we're kind of heading to a world where there's going to be markets about pretty much anything and everything, right? So for example, I think every artist on Spotify will have a market about how many streams they're going to get, or if they're going to release an album, or if they're going to a Grammy, or every county in America will have a school board election. Every KPI for every stock for every publicly listed company is going to have its own market. I think like this is it's a unique factor of prediction markets that like you can just list a market about anything, and then exchanges are going to be game theoretically incentivized to list all those markets. And when you think about how it's going to get easier and easier to get price discovery, especially you don't need that much liquidity, and agents might be doing the vast majority of price discovery on the vast majority of these markets. There's going to be a lot of problems that need to be solved to help prediction markets scale as an industry. And so these are the kinds of things that if I was thinking about oh, prediction markets are really exciting, I maybe want to do a project around them or build my own company or do something. With every asset class that rises, there's an entire infrastructure or market structure around it that is like quite important for it to really scale. One example would be like if there's this long fat tail of markets, you need some way to trade them more ergonomically. And an index is a great way of doing this, right? No one goes and buy when you want to go long the American stock market, you don't buy 500 stocks. You buy the S&P 500. And I think you look at the quality of the business that Standard & Poor's is, and it's an incredible, beautiful business to be built because they get a take rate on any time anyone trades S&P 500 future. Um, and so what if there's like the S&P 500 for Democrats, or there's like an index that maps up all the far right wing markets of every country in the world, and you have this like macro theme that you think populism is going to go on the rise. Like now you have a way to create a tradable asset that is ergonomic for you to express that view. Um, I think another thing is that like there needs to be more Oracle resolution infrastructure. So people talk about how prediction markets might disrupt insurance, for example. And like, if you think about why hasn't it disrupted insurance yet, this is a whole thing. I could talk about it for hours, but like, I think what you need is some kind of resolution source that's able to tell you what the wind speed of every cul-de-sac in Florida is, because that's the only way that someone is going to open an app and make a trade on what's about to happen to their house, right? We could dig into that later, but I think like the reason why this is just illustrative. Like the reason why prediction markets look like sports is because has been all this infrastructure around sports already, and then it was really easy for prediction markets to eat it. But now there needs to be all this infrastructure built out to for prediction markets to then eat insurance or to eat media or whatever it is, right? Like I think there's a lot of potential here, and we're still so early. Um, Trading technology to harvest liquidity rewards. One-way exchanges are going to compete to get price discovery in liquidity is by offering decentralized liquidity rewards like Polymarket does. And so if you want to be levered to the rise of prediction markets, building the app that lets you harvest those is, I think, really powerful. I think AI agents will be trading a lot of prediction markets, so maybe the picks and shovels to trade AI agents will be really necessary. This is something that Jan himself is working on, which is really exciting. I check it out, elastics.ai, and thank you for him for hosting this. Or maybe like prediction market native media companies, right? Like if imagine I'm from Ann Arbor, Michigan, which is in Washington County. If the Ann Arbor News was a newspaper that we would get like every day or as when I was a kid, and then local news pretty much died out completely because it didn't make sense. The economics around hiring a staff and having an office, around building a newsroom for a small city like Ann Arbor didn't make sense anymore. But now, what if there is markets for every single thing that might happen in Ann Arbor, like how much snow will fall, which it's a lot. I lived there for 20 years. Like I know it's a lot, so I'll go long. Or who's going to win the school board election, or who's going to be the mayor, or what is going to be in the curriculum. And you create markets on all of this, and then you just put it, like, $1,000 of liquidity in each one. Then you immediately then like create a very useful informational news product for everyone who lives in Washington County, right? And for not that much money. And I think like that is an interesting way to potentially like bring back like really accurate, really trustworthy, and highly calibrated news media to local jurisdictions again, which is something that sadly died over the past 2 decades, and maybe prediction markets are the way that stuff comes back. So this is the takeaway. I think prediction markets are going to be much more competitive than traditional derivatives. It might not be as competitive as crypto because it's not as easy to do as crypto. Um, the competition is shifting to different new axes, and I really believe we're incredibly early. I think there's so much potential here. There's so much work to be done, and a lot of interesting companies to be built that aren't just exchanges, that aren't just competitors to Kalshi and Poly markets. Um, and that excites me. So yeah, that's the end of my talk. And I'll hand it back to you guys.
Thanks, Adi, very much. That's very exciting talk. So we have this huge contrast between like Robin going forward and Adi here and now showing us the precise mechanics of what's actually going on. Robin, would you have 15 more minutes for us?
Yeah,
what's your agenda?
I teach a class in 27 minutes here, so
amazing. Robin,
works for me too. Yeah,
that's amazing, Adi, because I thought that maybe you guys can just have a bit of a conversation. If there's something maybe Robin, you would like to hear more from Adhi, or you Adhi from Robin? Just you guys know better.
So you said there isn't much price pressure from customers, but prices have come down. Like, decades ago, people were using bookies who took a 10% vig, right? I presume, these websites are cheaper than that. And now you said this one that charged more is getting less customers now. So there is some sort of lower price trend?
Oh, sorry. Maybe no. I was saying so. Robinhood charges a lot more fees than Kalshi, and yet Robinhood is delivering most of the flow.
Right. But
That
they're both
maybe
a lot less
So
than bookies used to be, right?
oh, for sure, for sure. And so I think like, but the thing is like it's more of an ergonomics thing. So people in California and Texas where sports betting is not legal were then able to now log onto the Robinhood app and trade something that they've never been able to. And so that's a huge part of the success. But also um, the volumes on FanDuel and DraftKings have not gone down. FanDuel has made more money than ever in this past quarter, and so I think that's like really evidence that people, especially sports bettors, are not that price sensitive. But yeah, the way Kalshi will disrupt the sports betting app is that the fact that they can offer something about Zoran Mamdani and Taylor Swift at the same time.
Right.
And so yeah, that's how I see it.
So, as economists, we expect that if prices
Yeah.
come out, the quantity will go up, that as costs are going down, so entry will up. People will enter into the point where there's near net zero profits. And so if they're not, if price isn't the way they come to equilibrium, it'll be quantity, right? So that's why you would predict so many more topics and so many more markets, is because they're not competing on price, they're competing on how many and what topics you offer, right? So
yeah, absolutely, I agree.
So what about the taste constraint? So you mentioned before some of these are in bad taste. Well, if there's a vast expanse in the quantity, I mean, usually taste suffers there, right? I mean, we have a vast expanse in movies and TV shows, and many of those are in poor taste to some people. How much will taste be a constraint here? If we have a vast increase in the quantity of what markets are offered, surely some of them will seem to be in bad taste to others. Is this a regulatory thing you think can happen, or?
I think it's a PR thing. If we look at like the blowback, like I'm not gonna lie, like I'm on Twitter and people see me as a prediction market person.
Look at, say, social media versus mainstream media. Social media is much bigger and it's in bad taste, and the mainstream media is always complaining about the bad taste of social media all the time. But there it is. People still consuming social media,
it's
right?
winning. I think the PR blowback on the Iran markets or the insider trading is like net negative for these platforms. So that's an example of taste blowing back, but also I think it's going to be this constant like push and pull of like, okay, let's push the envelope as much as we can until we get in trouble, and then like, okay, we learned our lesson and now let's be a little more chill about it. And if one platform's brand gets associated with really poor taste, then that might be deleterious to them and an opportunity for another platform, right? So I think, like, for example, if we want to compare it to media,
or commenters, right? If it's
reporters, that's so true.
The markets are in bad taste, but the traders like it. It's not so clear that a reputation for reporters complaining about the markets is going to push the traders away, right?
So one reframing, remember, so I really do think prediction markets more approximate media, right? So if we think about how the streaming platforms compete, for example, Netflix is dominating, and I think a big part of that is that they created this incredible moat of content by making more and more movies, a lot of it bullshit, right? Like, but the reality is there is still a lane for like prestige television. For example, people enjoy HBO because HBO Sunday is like differentiated in the quality and what you're getting with Succession and Industry or whatever, your White Lotus, whatever you're watching. One of these
sites will be the prestige site, right? Where respectable people feel most comfortable going, and they'll get a premium from that being the prestige site. But there'll be a bunch of other less prestigious sites, right?
Yeah, I agree. Yes.
So you're
so who's going to be the HBO?
If you want to be the prestige site, then you should be careful about these topics that people think are in poor taste. But if you're not going for that prestige slot, don't worry so much about having your reality shows or the
Yeah.
TV stations, et cetera. There are the less, if not, HBO doesn't do a lot of reality TV, right?
I don't know.
Or game
yeah, I'm not
shows,
sure.
right?
Yeah,
but
exactly.
there are venues who do those low class things that a lot of
Mhm.
people like. And I guess I would say, unless it's regulation that comes in, I would think these low taste sites questions will be supplied by
Oh,
somebody.
they're gonna do well.
Gentlemen, about the
Yeah.
taste of the markets, Polymarket dropped down this market on nuclear attack, and there was this controversy about Khamenei, which you just discussed. But is there, except for the taste, a place here for ethical considerations and then regulatory actions? Like basically the question from me and one from Pipquant here on Twitter would be, is there are there some prediction markets that should not be there basically because of very, let's say, demonic incentives?
So we're both economists, so we can just go through the usual economist arguments. The most
Yeah.
straightforward
You
one
want to take
is
that one?
people waste time and money in betting, and that's been a reason they've been illegal for a long time. But of course, people can waste time and money betting in all the other financial markets. So it's not clear that cutting out this takes away options to do betting. And then people waste a lot of time and money on sports in other ways besides betting. So I think you should just compare all of the ways to take waste time and money.
The point is here, given the, let's say, non-linearly scaling insanity of the world in which we are living. Just remember, in the last 3 weeks, we have Epstein files, UFO, and Iran. That's something, yeah? So it's like, it's going insane. So given this insanity that we are starting to live in some sense, like if you have prediction markets on nuclear attack, is it not very perverse in terms of incentives, also in the context of this insider trading, understanding that insider trading is a very bad legal frame for whatever is happening on prediction markets? That's the thing you're explaining, Adhi, in your clause, and Robin, you're also explaining it as a confidentiality problem, yeah?
Information markets or prediction markets here are an information institution, and they have the weaknesses and faults of all information institutions, including journalism. So there are times and places where we don't want more information. For example, some people think on election day, we shouldn't be reporting on, like who's going to win because we'll discourage people from voting late on election day. That's a reason why maybe that's information we don't want. And then for military actions, maybe we think we shouldn't allow information about military actions to come out ahead of time because that might undermine our military strategy, right? Those are reasons why we might want to censor all information institutions. I would just say, let's have a uniform policy. So like a bill went before Congress in the last month that said government officials shouldn't be allowed to trade in these markets because they might reveal secrets as government officials. Okay, if you're going to do that, then don't let them talk to reporters either, because reporters, they can also reveal secrets to reporters. If you just want to censor a topic, do it for all the information institutions, not just this particular one. But I would say, like, information institutions have a number of known problems. They can waste your time and money. They can tell people things when we think that information shouldn't get out. People can try to manipulate them. They can induce sabotage in the world. These are all known potential failures, not just of this, but of journalists and gossip and all the other information institutions we've ever had, including academia. All of those things can go wrong. And yes, there are ways you might want to regulate in order to do that, but those will always give excuses for people who just want to censor because they personally don't like what's being said. And you have to be careful about drawing the line to allow regulation that would deal with these problems without just giving an excuse for censorship, but then also just treat all the institutions the same. Apply the same rules across the board.
Adhi, what's your take on this?
My take is if you don't like it, don't trade it. I think no one's twisting your arm, no one's forcing you to trade it, no one's forcing you to look at it. I think the amount of moral panic is extraordinary, and is really driven by I think the clicks media industrial complex, right? Where you can very easily get an op-ed approved by the editor of a highbrow left-leaning media institution if you like shit all over prediction markets and say it's dangerous and it's insiders and this and that. It's like you don't, if you're worried about getting addicted to gambling or people are losing your money, then don't trade it. If you're worried about getting picked off by an insider, then don't trade it. If you don't like it, don't trade it. If you don't like it, don't look at it. Don't sign up. Don't go to Kalshi.com and sign up. Don't go to Polymarket. Don't deposit. Like, I think like this is my take as someone whose net worth is 99.9% Kalshi equity. Like, I will tell you, don't go to Kalshi. Like, don't sign up and don't trade it. And maybe that's like this kind of harsh or whatever obtuse way to talk about it, but like I don't care. And I think like I have the freedom because I'm not the CEO of these companies, like to say that, like, I don't care if you sign up or not. I don't care if you use it. Like, I think I really care about understanding that these markets are valuable as an information and media product. And the amount of like moral panic that is around it is like way overblown, and especially the concept that like the market would like make it more likely for a nuke to go off or for someone to throw a dildo on the court or whatever. Like, yeah, I mean like on the fringes, yes, but it's kind of like missing the forest for the trees, right? And the power of having an unbiased, highly calibrated pricing of the future, pricing of risk. It's a very high level, lofty concept, but like we all care about the future. It's like what our main, we all are extremely concerned about it,
Yes,
right? Like
Abby,
it's the main thing that we're all worried about. So why
and I
not
think
just don't trade it and just use it as the price information and just relax? You know, like I think that's my opinion
and
here.
here's
You know,
the moment of
yeah.
like just to hit here like the summary of your take about, because you get great article in our blog about why insider trading is a very bad framing for whatever is happening. And it seems like founders of Kalshi, they got boxed into this narrative. Oh, we are fighting with insiders. But the point is that I don't feel like we are having this problem of insider trading at prediction markets. So Robin is talking, okay, go after guys who breached the confidentiality duty, but this is a contract between them and their institutions. It's not about markets there, basically. So maybe you can also
Yeah.
summarize for listeners here your take on this, because it's very, very well articulated there.
I think the line between what is an insider and what is simply edge is very hard for people to understand and conceptualize at first blush. It's easy for me since I've been a professional prediction market trader for 6 years. I've gone to extreme lengths to get edge, right? And that's what it's all about. But for a lot of people, at first blush, it's like the concept of like, oh, I'm like, I want to bet on something, but then like someone knows better than me and I'm gonna lose my money. It's like this kind of, you know, deleterious concept to them. And I'm like, that's the point of this, right? It doesn't if you make a bet and you're wrong, does it really matter like in which way that you were wrong? Like if you were wrong because you were unlucky, or if you're wrong because you didn't know, if you're wrong because someone else knew better than you, like you're still wrong, right? Like there's plenty of people who are on the other side of the bet who weren't insiders who also got lucky and made money, right? I think like this concept of like being picked off or being adversely selected by insiders is kind of like the way I see a lot of people talking about it, they don't realize that that's the kind of the point of it, right? Like the thing wouldn't work if people with better information than you didn't make money. And so again, don't trade it. If you don't have the best information, if you don't know what's going to happen, don't trade. Don't lose your money. 90, like most people are not going to be good traders. Most people will lose their money. I'm one of the few who was a good trader and I worked my ass off to be a good trader. And if you're not willing to do that, then don't do it. Like that's kind of it's just
There are
be
there
real
are
with
amateur
yourself,
sporting
right?
leagues where it's important that none of the professionals can play. And if you want a sporting contest where you make sure it's only amateurs, then fine, make a website like that, and then those people can play.
Yeah, that's a good idea.
It happens in sports, and it can happen here in markets, but sometimes you want the professional market, right? You want the professional contest.
Yeah.
You want to say, you want a basketball, regime where tall people are allowed to play because they're better players at basketball, and you don't want to make sure no tall people are allowed to play because that would be unfair to short people. You can make a league like that, but most people like the league where the best people play because they want to watch the best play. And so that's what people mostly like in markets. They want to play in the markets where the best people are playing because they want to be the best. I mean, there's a history of journalism here. Several centuries ago, when journalism first started, it was challenging the authority of governments and church and aristocratic leaders. And they dumped on it, saying, like, who are these people? They're low class. They're sensationalists. They're trying to undermine our authority. They're distracting attention from the proper authorities. And people were saying that's not fair. These people should be reined in. And much of the world did rein in journalists by making sure they were under the thumb of the proper authorities. And now that journalists are the proper authorities, they're dumping on competitors who they say are too sensationalist, too getting too much attention, not properly restrained and vetted by professional ethics and their high class, morals. I mean, that's basically what they're saying.
Robin, let's maybe close with the last questions from users to you. And Adi, if you have some comments, just also please jump in because we are just short on time. Good. So NCB and Mixai, basically they are asking, what do you think are the biggest practical obstacles from preventing Futarchy to being tested at scales and prediction markets being used for social and political decisions? So this is the same question basically from two users. What are the biggest obstacles, Akor? What do you think?
As I said in my talk, all innovation is a combination of elegant ideas plus messy details. And you have to do a lot of experimentation to work out the messy details. So for decision markets, we've just needed to do more trials to work out those details. And the primary obstacle hasn't actually been legal. You can do a lot of experiments within organizations without running afoul of gambling laws. It's that they are disruptive to organizations and they're shy about doing things that are disruptive. So I'm excited that in the last few years, we've had some organizations doing these trials, and let's do more of them. And the more trials we do, the more confidence we can get in where and when they work and how we've overcome some of the things we're worried about. And that's the main obstacle, just doing stuff. So all of you people out there, you could probably get your organizations to do these trials if they wanted to. It's not a legal or technical barrier here. It's a willingness.
Guys, I think the message is very clear. Just do it. Do prediction markets. And as Adi said, if you don't like them, don't do them. If you like them, just do them. And I think we can finish up with this message. Robin, thank you very much. Adi, thank you very much for your time, guys. That was a great
Thank you for having me. Thank you for having me.
Yes, and I just cannot resist myself from marketing a bit elastics here. Guys, we are releasing our private beta right now. You have link here. Just register for waitlist. We are craving for your feedback because we want to build this product for you. And as Adi said, we are very inspired by this idea of making it more searchable, more practical, connecting all the venues, and just put AI that will help you browse through all of this, because there'll be a lot of noise, and we want to provide you as much signal. But to get you a good signal, we first need your feedback because we are just starting. Again, Robin, Adi, thank you very much. Take care and hope to see you soon.
Thank you for having me. It was a pleasure.
Thank you, guys.